As always, the Federal Reserve remains steadfast in pursuing its dual mandate. Excuse me. These goals are complementary, but labor market, excuse me, 2% over time while supporting a labor market that can Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Monday, April 7th, 2025. Today's episode starts with a headline. That was the bounce. The S&P 500 can drop 5 to 20% tomorrow because the tariffs have teeth. The bounce that we saw today was largely because of a rumor supposedly coming from the White House that the tariffs might be put on pause, and that rumor was put to rest later on. So I'm thinking the market's still in free fall here. And if we were going to get a bounce on the way down, I think this was it. We'll take a look at charts momentarily. Next headline, break-evens prove that inflation is not a part of the equation yet, although the 10-year yield rose today by, well, there's no point in saying the percent of a percent, by 17 basis points. The 10-year break-even inflation rate still remains low and still looks very much like it's crashing at the moment. So the markets are seeing disinflation here. And, if you take a look at the 10-year note yield by itself, plus what people are saying in the news about inflation, how that's going to get things out of control, this market is not worried about inflation. This is the market to look at when you're looking to see how inflation plays into things. If you didn't catch me saying it on a previous show, I did exit my gold short. I made a good profit on it. It was probably a little too early. I didn't wait to get to the target. I guess I should have waited to get to the target that I highly suspected it would get to. Got pretty basically close enough today. Anyway, I'm not short gold anymore. And I want to remind everybody that while we have all of this volatility again, my favorite position as far as potentially doing something in the short term is perhaps shorting the VIX using options, because if you buy these funds directly, you can end up with a K1, which is a pain in the butt. So calls on SVIX or puts on UVXY, especially if the VIX spikes up to 80 or 90 and you happen to be able to trade at that time. For me, that's an easy day trade that would be really nice to get into when it happens. Obviously, it never stays above 80 for very long. It can't really. So potential opportunity coming up. But for now, I'm sitting on my hands. I'm not really doing anything. And that carries us straight into the community topics. This has been a great question. I love hearing what you guys are doing or not doing. Comment below, what moves, if any, did you make today? Or are you like me, just sitting on your hands and confident about your positioning? I don't know how relevant it's going to be with all this chaos going on, but we do still have CPI and PPI coming out later this week on Thursday and Friday. As always, thank you so much for watching, subscribing, commenting, and supporting. I don't really see a point in redoing the daily reminders until things start to settle, and that could be a while. I still recommend watching this show if you are new to the channel, called Macro Update to 1125. Today I added to the daily reminders a point that I brought up yesterday that is in progress basically right now, which is, I believe strongly, Trump and Powell are frenemies with benefits. We're in the midst of a bubble popping, and the deflation potentially ahead is actually unfeared, which is different from the past two major cycles. Ever since 2000, we've still had this fear of deflation, that we weren't going to be able to create inflation with the Federal Reserve and fiscal spending. And we proved that we really, really can achieve inflation. And so they're not afraid of the other side now. This is my main point that I haven't heard other people say. I think it's original, and I think it's an important perspective to consider. Believe it or not, no major changes still in the crystal ball ratings or the Robschild portfolio. It stays the same. Watch portfolio update to 1125 to hear me explain it. Onto the charts, I want to go deeper into the first headline that this was the bounce. The tariff pause was not true. We opened pretty good lower today. We went up on potential good news, as any good news gets people to be like, oh, the stock market went down, now I should buy a bunch of stocks. So we had a green candle that actually closed 0.23% lower than yesterday's candle. So we still ended up having a down day, but this was the bounce in my book. I was curious to see at the end of the day, what are people buying here? And I find it a little overly optimistic of people that are buying this market, seeing as though the one-day performance shows technology is one of the top performing sectors day to day. For me, this is just a lot of dumb money going into the wrong thing at the wrongest thing at the wrongest time. And this further supports my idea that we could have a 5 to 20% move down tomorrow. Add to that the advanced decline line dropping significantly lower, while the S&P 500 is going only a little bit lower. This is saying, most stocks, the majority of stocks are going down, and so it's probably going to keep going down. It also means that people are still enthralled with buying very overvalued stocks like Tesla, Amazon, Facebook, CoreWeave now, I guess. The bigger names are getting bids, and most of the market is still collapsing right now. Next chart I want to bring up is the VIX, the Volatility Index. Again, if I was going to take a speculative position right now, if I were to get into something, it would be shorting the VIX. And if you happen to somehow catch it at the top at 60 today and write it down to the end of the day at 47, you would have made yourself a heck of a good profit. I am sort of waiting until if we happen to get to historic high range around 80 to 90, and then it's extremely obvious that it will not stay up in that range, not for a month, not for 2 months. And your typical options contracts on these things are, you're gonna not buy one a week away typically, a month or two away. And it's an easy way to make some money on the way down on the VIX is the way I'm looking at this. But again, it could be just the middle of one day where we just pop up to 90 and go straight back down. And it could be hard to catch, especially if you have a day job like me. HYG is dropping, and so the 3% of my portfolio in put contracts on HYG that I have been accumulating over the past 6 months those are playing out to my advantage right now hugely, and I'm still holding them. I'll let you guys know if I sell them, but another piece to this puzzle is the fund that I'm looking to actually buy would be HYT. And I'm actually, I kind of wish I somehow caught the very bottom of this today. Junk bonds have a pretty decent amount of safety. They're bonds, and so the companies that hold that owe this debt, they have to pay these coupons no matter what, even if it means selling the whole business. And so there's a lot of safety built into the structure of these bonds. They're not like stocks where stocks can go to zero. Junk bonds can't really go to zero necessarily, unless the company has so much debt that they really can't pay the bondholders anything at all. But again, this is a diversified fund, and not all of the companies in this fund that have debt are going to go bankrupt. And that's why you have pretty darn good safety and potential return. I just want to comment that HYT intraday reached, from the all-time high anyway, almost 23% down. So this is something, for example, if it were to if we were to get below this range, I'm going to start buying it actually, while at the same time still holding my put contracts on the other junk bond fund. It seems weird sometimes for people to go long and short like the same position, but I want to cost average into junk bonds at this time. They're discounted right now, and to ignore that is I can't ignore that. The amount of safety and potential return here is enormous when junk bonds get heavily discounted. So if I do anything, this is the other thing I'm looking for. Actually go long HYT instead of HYG, just because it has more beta. The upside is actually greater than HYG because of the higher beta. I made a very good call on Thursday's down day, and the dollar being, I was very surprised by that. I said it would reverse. It reversed on Friday, and we had follow through to the upside today. Again, I made a really good call there. I'm just patting myself on the back here. Sorry, I digress. The way that I see it, a crashing market means there's going to be a run to dollars, a run to liquidity, a shortage of dollars, believe it or not. If you don't understand how a shortage of dollars works, there's only something like $3 trillion that actually exist in the world. The rest of it is just perceived debt, what people are willing to pay for things. The actual amount of dollars is a lot less, and when everybody needs those dollars at the same time, the dollar index can certainly go high up. While I still don't think it's a great idea at this time, it's pretty notable that over the past few months, ARK-K, Cathie Wood's flagship fund, is down now 43%, or at least intraday it hit, from the not all-time high, just this recent high, we dropped 43%. I am absolutely sure there's plenty of buy the dippers coming in here. I am not one of them, not on something like this, not in this environment. But if you buy it and you're successful at trading it and making profits, good for you. It can be done. I just think it's like really dangerous when the S&P 500 is just like gapping down below, like just slicing through trend lines that traders were expecting to bounce. You have these guys, they put their order in and they buy it, and it just goes right past, like pressing a button on an elevator and hoping that the elevator stops at the floor that you're at to bounce up or something. I don't know if that's a good example, but then it just goes right past you and you're like, uh-oh. Yeah, I don't want to get hurt like that. While I don't like using momentum strategies to the upside, in other words, jumping on something because it's going up, I don't like to do anything on the downside either. I don't like to jump in on shorting while it's already going down, and I don't like to try to catch bounces. Not my game, not my cup of tea. But people are doing it. They're trying to do it, and some of them are being successful and making fortunes, and some people are on the other side of the trade. I also want to bring up the Russell 2000 small caps. From the previous all-time high, we intraday today reached almost 30% correction in the Russell. This is deep in bear market territory now. The cartoon at the beginning of the episode represents the fact that the Fed funds futures and probably Powell are not really looking at any emergency cuts. Not yet. Not until they start getting calls from the major banks that say, you gotta cut rates, things are blowing up, or the whole world's gonna end, or the banks are gonna collapse, and then he'll cut, the way he always does, if it ends up playing out that way. But the point is that we're still only looking at the 4 cuts. That hasn't changed today anyway. I mean, it hasn't really changed much since this whole crash began, hence the cartoon at the beginning. Just want to bring up a reminder on high yield corporate spreads, how much junk bonds have to pay above the treasury rates. We are spiking to the upside, and yet we're still not super high. We're around the same that we were in October, end of October. We're not even to the peak of 2022 when it got to 6, but it's going in that direction, and this also supports my idea that the market is still in full out crash mode right now. But what do I know? Oh wait, there's one more chart. Last chart of the day, Ingalls Market IMKTA. I wrote in a post this morning, if you happen to catch it, or maybe it was in my morning update. Either way, I noticed in pre-market this was down 10% in pre-market. I kind of wish I got in there because I would have made 10% on that. It went right back up. In fact, it closed positive today. through this whole crash, this has remained fairly stable as expected. It's a grocery chain and a highly undervalued one at that. This is a stock that I will accumulate more in the $60 range. Right now, my position is something like 2.5% of my portfolio. I want to increase it to 5%. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching and see you next time. Robschild.